Hi, everybody. My name is Yvette Spillman. I'm the CEO of Wealth Protection Partners, and I'd love to welcome you to today's webinar. Thank you for joining us. I hope that this brief information that I'm going to present to you is really helpful to you. The title is COVID-19 Killing Your Retirement Savings. I hope it's not, but the title indicates that we'll be discussing just a little bit about what's happening to the market right now. And in any time, really, even in market good times, market up times, what can you do to participate in the market while still having safety and not losing your money in times like this? Now, why this webinar is so crucial is not just the COVID-19 pandemic and what it's doing to the market, but it's also crucial because this may be a time when a lot of baby boomers like yourself are trying to retire. And as we know, market risk and retirement don't usually go together. It's a time to preserve all that you've saved and not lose it, especially with longevity on our sides now, modern medicine, and all the advances that are being made there. We're living longer, our retirements are lasting longer, so it's important to preserve what we have. Also importantly, I just would like to bring out that here at Wealth Protection Partners, I'm the lead agent. I have been an advisor for 22 years, and I can actually reach out to both the market realm and the secure realm. So that's oftentimes big insurance. So I have no bias in either direction, but I'd like to share this webinar with you today because a lot of the information that we present today is not very well known. Oftentimes we see that Wall Street controls the dialogue out there. They control what's put up on the internet. They control what the celebrities on TV discuss as far as finance. So this is not that well marketed, but it's very important. And I'd like to share this with you today, talking about growing your money while it's in a secure and safe environment. Very interesting. So we'll be brief today. Let's dive right in. Here you'll see a calendar page. Now, when you are done with the webinar and you'd like to book a free consultation, please just jump here on the calendar, pick out any of the times that are in blue, and click on it. It'll ask for your information and it'll pop you right onto my calendar. Okay, so let's go. S&P 500, let's take a look here. If we went back just a little ways in time to January 1st through March 31st of this year, and we had, let's say, a market balance starting out in our portfolio of $500,000, and it was 8 a.m. on January the 1st. Let's go ahead and start the clock. And if we end at 5 p.m. on March the 31st, take a look at what happened. Now, this, mind you, is just tracking S&P 500. This is legitimate, real time here. We would have lost, my gosh, quite a bit, $103,350 of our account value. This may have happened to some of you. So what does that actually mean to us when we see six figures disappearing? Of course, it's painful. It's awful, again, especially if we're trying to retire right now. But we have to think a little deeper than that. It's not just a dollar amount that we've lost. So if we think about it from another perspective, let's go ahead and apply the 4% rule. If you're familiar with that common rule, which actually is quite outdated, the 4% rule says, well, if we had $500,000 or whatever we have in our portfolio, and we multiply that by 4%, that is the dollar amount that we should be able to take out every year for at least 30 years. So what does that translate to when we've actually lost $103,000? That actually translates to 5 years of lost income. Not good, not good. What would our solution be there? Just to die sooner? That's ridiculous. So how do we recoup that 5 years of income? That's not the easy part. So let's take a look, because now we have two things, right? We have the dollar amount lost, that hurt. We know that that translated to about 5 years of income, that hurt. But what else? This part about recouping the money, how can we do it? Let's take a look at that. Here's something that unfortunately we call in finance, we call it the dark side of compounding interest. So what this is illustrating is that if you lost 10% of your account value, it doesn't take 10% gains to get back to even. It would actually take 11%. Okay, now this is just how the math works. If you lost 20% of your account value, you would actually have to earn 25% to get back to even. To zero, I should say. If you've lost 30%, notice this. So many people in 2008, 2009 got hit right here between 30 and 40% losses. Even today too, unfortunately. But if you've lost 30%, it takes a whopping 43% gains to recover that. And notice the numbers just keep getting worse. A 40% loss takes 67% gains to recover. And dare we even look at a 50% loss, you would actually need 100% growth to get back to even, to zero. So we get the point, don't we? Market losses can be ugly. We can look at them in different ways. They translate both into dollar amounts and into time lost. So additionally, it's hard to recoup from these losses, especially when we're trying to retire and we don't have time on our side to recoup that money. So moving some money to safety is a sound strategy. But let's take a look at the options. There are some safe money strategies that don't really make your money work. In a book that I'm writing, I talk about how, you can kind of picture your money sitting on the couch, eating bonbons, watching a soap opera, and it's doing nothing. It's doing nothing for you, when really it should be up on the treadmill, jogging and working hard. What are some of these investments? We think about CDs, money market accounts. Oh, please, right? Just the thought of them and we're cringing because the interest earned is so low. Look at these numbers. CDs are currently earning between 0.5% and 1.5%. And I've had some of my clients excitedly tell me, hey, I'm making 2% in my CD. Well, that's not enough to get me excited. I'm still picturing that money sitting on the couch, getting flabby and eating bonbons. The money markets, please, less than 0.5% growth, some even at 1%. And so these types of safe accounts where you can keep your money safe from market losses are just completely failing to keep up with even basic inflation. So let's take a look at this. Let's just illustrate it here in this chart. Now, if we start at age 65 in our retirement and we have our money in a CD, now we know we're not really gaining any interest, maybe 1.5%, plus we lose that, right, when we get the annual 1099. But let's forget the 1099 and the taxes for the moment, and let's say we can take out $50,000 a year from our CD. Okay, so if we start out at age 65 and we go to 95, well, we would have needed or taken out $1.5 million over this 30-year period. But notice what happens if we get realistic now and we apply inflation to these numbers. Look at this. Actually, with inflation built in, we would not have needed $1.5 million. We would have needed $2.378 million, right? That's almost $1 million more just because of inflation, which is currently at about 3.2%. So what happens? What happens if we've left our money in a non-profitable account like this, like a CD or a money market, just to keep it safe? Well, as we could see, we would have to have compromised our quality of living. We would have had to reduce our expenses because our value of the dollar, our buying power, could not keep up. Now, who wants to do that? Who wants to reduce their quality of living? Certainly not me, and probably not you either. So just to highlight that, it's a shortfall we would have had of $878,771. That's a shame. So obviously, leaving our money in these accounts just to keep it safe is not a good answer. So one other thing happens, which is interesting. Not only does the money fail to keep up with inflation and causes us to compromise our living, but also when the market does rebound, if we're in these investments, these low performing investments, we would completely miss the market bounce back or the market upside growth when it does return. So this is where people say to me, well, Yvette, CDs, money markets, we know about that. They don't earn anything. But what about bonds? Well, it's a little bit of a sad story there. Now, remember, in the 80s, the 90s, CDs, money market accounts, bonds, huge, performing through the roof. I remember very clearly one CD that I had seen was at 24%. Granted, taxes were up higher too, but let's look at this chart illustrating the point. If we see over the past few decades, as we look at the chart, bonds were soaring. The values of them were up high in the 80s. And then from low about the early to mid 90s till now, they have made a steady descent. It's unfortunate. So bonds in today's market as of 2020 have the record lowest rates they've had in history. Now, if you're in a bond fund, like a mutual fund, there's something unique happening there as well. In bond funds, you are actually, because the funds are continuously sold as people get out of the fund. And like with mutual funds, there are fees and management fees, etc., administration fees. But what's happening is as people sell off the bonds and new bonds are purchased to replace, the volume of the pool, the new bonds being purchased are of lower value, lesser value. So you're losing money there as well if you're in a bond fund. But again, as we look at this table, we see bonds suffer low interest rates, risk of excessive expenses and decreased value. Again, failure to keep up with inflation, and guaranteed to miss the market bounce back. Now, if we look back on that 4% rule for just a moment and use this as an example, by the way, that 4% rule was based on a study conducted by a gentleman by the name of William Bengen. He was a financial analyst. In 1994, he performed this study doing multiple tests on the market all the way back to the Great Depression. His question was, how much could you take out of a market portfolio given that it was 60% stocks and 40% bonds? How much could you take out sustainably for a 30-year period, let's say 30 years being a standard retirement? Well, unfortunately, no longer can the 4% rule survive. You can't just take out 4% and expect it to last 30 years because the bonds portion of your portfolio has collapsed, as we saw in the chart. So Morningstar came back and said, well, we appreciate Mr. Bengen's findings. However, due to what's happened to the bond market and, of course, rising inflation, we are looking at adjusting that 4% down to 2.8%. So just to summarize that, they're now saying, experts are now saying, and analysts of the market, that all you can take out of your portfolio is an average of 2.8% if it's going to last you 30 years. So what does that mean to us? That means if we don't replace the bond portion of our portfolio, here again, we're reducing our cost of living, reducing our quality of living by having to reduce expenses because we have less to pull out, less to live on. So the new rules in 2020 are as such. Number one, the Fed has slashed interest rates down to practically zero. And interest rates, as they rise, now we see bond values decreasing. So if you can picture that in your mind, interest rates start to creep up. They can't go any lower, right? They have to go up. And as they go up, the bond values decrease even further. So analysts and specialists taking a look at this scenario have proven a point by saying bonds may be a far worse investment in the future than they have been in the past. And Wade Pfau, famous market PhD analyst, financial analyst, made a good point. He said here, bond funds don't even belong in a retirement portfolio. So what do we do if we have bonds? What should we do? Now remember, we're looking for security. We're looking for some sort of protection against market downside, and we're looking for a replacement for our bonds. Because here, as we see in this slide, bonds aren't performing, CDs, money markets, out the window. So where can we go to get the kind of growth that we need and remain safe? I think the answer might surprise you. The answer is actually fixed indexed annuities. Now, don't be scared by that. I know some people say, oh my gosh, annuities, I've heard terrible things. Unfortunately, there's a lot of propaganda out there that is misdirected and untrue. So let's take a look at what these annuities really can do. Let's look first at the pros. Number one, downside protection. So when your money is in an annuity, let's say we took the bond portion of your portfolio or the lazy money that's in these CDs or money markets, and we put it here in a special type of fixed indexed annuity, not a variable annuity. That's an explanation for another day, but we would never select a variable annuity that continues to expose you to market downside and charges excessive fees. This is a different critter altogether. Remember the title, fixed indexed annuity. So 100% protection and guarantees against market downside. It's linked to a market index like the S&P 500. And you can only participate in the market upside. There again, another way of saying that your money cannot go down when there's a market downturn like we see right now. Can you lose those gains? If you gain something when the market comes back up, can you lose that? No. Your gains are locked in annually. But there's the other side of the coin, right? Annuity cons. What are the downsides of these annuities? Well, unfortunately, we find that a lot of them have not been structured properly. So for those that haven't been handled right or put together correctly by the advisor, number one, they have low caps, low participation rates. And when we see a lot of them in my practice, when people bring them in, I often see that they have riders attached that don't need to be there, that these folks don't need to have. And these riders come with a cost. So when we combine the low cap rates and low participation rates along with riders that cost too much, that ends up in low returns. So sometimes when we think of annuities, we think, well, can I really do better than a CD when they have low returns? Well, you sure can. Let's look at how. The key is this: properly structured fixed indexed annuities. Let's look. We call these, sometimes we have a little catchphrase for them. We call them simplified or simplified accumulation annuities. Again, they're still equity index annuities tracking an index, but these offer no fees, no charges. They have uncapped growth. Now stop and think about that. Just like when you're in the market and the market goes up and there's no cap on that, so too here, uncapped growth. high participation rates. As the market goes up, you can participate in that upside growth. And then, of course, we want to look for highly rated, A-rated carriers. Okay, triple A, A-rated all the way. Some carriers are B-rated, and we don't want to tangle with those. So I love this chart, folks. Please take a look at this with me. This is a brilliant chart, and it's very impactful. If we look here at this red line, and by the way, if you, at the end of this webinar, when you reach out to book your appointment, please ask us for a copy of this chart and the white paper that goes with it on understanding annuities. Now, if we look at this red line, the red line here signifies the actual market. This is the actual S&P recorded from 1998 to 2019. And we see that descent beginning there. Okay, now watch carefully. The green line, wow, the green line is a simplified accumulation annuity. You'll notice it beat the S&P 500. So what happened here? Well, an investor who put in $100,000 in the market in 1998 had a total in his account of $241,903 in 2019-2020. If that same investor had put the $100,000 in a stripped down indexed annuity, look at that. He would have had $330,837. Why? How did this happen? Number one, no fees. Number two, look at the line there by 2009. Do you see the red line, how it plummeted down, indicating the market downturn that happened? But look at the green line during that same time, it's flat. So there again, this annuity protected the investor from the downturn of the market. That's how you come out ahead. These accounts allow you to only take market upside. Very powerful. So let's just jet through this section here. We're going to look at a living example of that chart. We have two clients, John and Jane, each of them with $1 million in their accounts. Now, John went with a standard portfolio. He had the 60% of his money in stocks, 40% in bonds, as you see here on the left. Jane, on the other hand, well, she was the green line. She went with the simplified accumulation annuity for her money. Now, each of them are retiring right now. So they need to take out $40,000 a year as income. Let's take a look. Well, you know, the market is tanking right now. So, of course, in the first 2 years, they both suffered market downturn, 21% and 15%, followed by some market gains. So what did that translate to in real numbers? Let's take a look. Well, 21% took money away from John. We notice his $1 million account value went down to $790,000. Jane suffered no losses. And this is key, folks, because this happened in the beginning of their retirement, just as it can happen in the beginning of yours. So Jane, she still had $1 million, even though the market was down 21%. Okay, so starting reset, right, year 2, or end of year 1, here's their new account values. Now, they both took out their $40,000 to live on, all right, and then year 2, the market went down again, 15%. Oh boy, so John's in trouble here. John is down to $637,500. He's taking a hit. Jane, on the other hand, didn't lose anything. She's at $960,000. That's just reflecting the $40,000 that she took out. Okay, so these are their account values. And then they came in and they took out their year 2 income. Wow, look at the difference. John is all the way down at $597,500. Jane, $920,000. So the point here is not only did the market take money from John, but The bond side of his portfolio was not able to swoop in and save him. Year 3, the market starts to come back up, and notice, this is also really important. John took the full rise in the market. He got all 14% growth. Jane, on the other hand, had a spread, a participation rate on her account, on her annuity. So she had a 50% spread and only gained 7% of the growth. But look at the difference. She's head over heels ahead of John. Okay, now they took out their $40,000 again. And finally, as they begin year 4, the market went up a good amount too, 20% growth. John again took all 20%. Jane only 10%. Notice the difference. My goodness, folks, can you see how that chart plays out in real life here? John, $769,380 account value. Jane, $1,038,840. Big difference. That was all accomplished by Jane avoiding the market downturn. All right, then they took out their money again. So overall, in just the first 4 years of retirement, by being in a simplified annuity, Jane is ahead by $269,460. Pretty impressive. And there again, I just want to share that chart one more time. Okay, just a visual. And again, you can have a printout of this just by requesting it. So the question then begs, okay, this sounds great. There's no fees, our money's guaranteed. We understand all of that. But how do we find one of these? How do we find a good one that's really going to do all these things that we've discussed? Well, that is hard. You can't just go online or pick up the phone and find one of these. You do have to work with a qualified advisor. Number one, there's 2,000 insurance companies out there. 100 of them have been in business for over 100 years. These are very stable, very stodgy, strong establishments that have been around for multiple decades, always operating in the black, never going insolvent. 73 of the 100 have an A+ rating. 7 of them have an uncapped index that they can offer you. And only 3 right now have a very high participation rate. So what we would do is get with you, understand your particular situation and needs, and figure out which of these equity index annuities that are simplified can work best for you. So let's discuss, let's talk together. How can we replace the safe money portion of your portfolio, the bonds, and the lazy money, and get your money up on that treadmill, get it working for you while keeping it safe? That's the key. Thinking again in your mind, hopefully, about John and Jane. So book your free consultation today, and we'll discuss your particular situation with you. A couple of things that you'll get with your consultation is a free customized report. So we'll run a couple of reports actually that are customized just for you. And we'll be more than happy to help you with that. So again, just hop on the Calendly link, the calendar link, and you'll be able to select a time to work with us. And then, lastly, I'm sorry, I think our computer froze for a minute there. Lastly, I just want to say thank you, and we hope that you and your families are safe and well during this time of COVID-19, and we look very much forward to meeting you in person. Thank you for being with us. I hope you enjoyed this valuable information.